Okay, peeps, welcome back. So today we're going to be talking about the uninverted yield curve versus the SPX and how it could affect dividend investors and investors overall. Let's get it. So the first thing that I want to bring up is we're not really so much focused in this video on what the Fed is doing. Okay, this has, I would say, some relevance to what the Fed is doing with rate hikes, but not really that much. What we're trying to show you guys in this video is what stocks could potentially do when the yield curve uninverts. Okay. So, first, let's talk about what a yield curve inversion and uninversion is. Basically, what a yield curve is when it inverts is, typically speaking, we like to use the 2-year and the 10-year as an example, but we know the Fed likes to use the 3-month and the 10-year. The reason why we like to use the 2-year over the 3-month is because if the 2-year is going to uninvert, meaning the yields go back down below the 10-year yields, it's going to do so first before the 3-month does. So that kind of gives us a front-running indicator, so to speak, ahead of what the Fed would be looking at. So when a yield curve becomes inverted, this usually happens as a result of the Fed raising rates, and the Fed raises rates to try to temper down on inflation, to get inflation under control. Because again, no currency, no country, right? You can't have a country if you don't have a currency, because that's how they use the economic system to control people. If there is no economic system, there is no control. So, and there is no flow of money, there is no goods and services, any of that, because the currency doesn't exist. There has to be a medium of exchange in order for people to transact between goods and services. So, with that being said, in order for the yield curve to invert, the Fed has to raise rates, which then causes bond yields to go up. And typically, what happens when it's inverted is the 30-year, which we don't have pulled up currently, will yield the lowest, and the 3-month will yield the highest. As you guys can see here, the 3 yield is yielding higher than the 10-year, and the 2-year, this is what's known as an inversion. Okay. When the yield curve becomes uninverted, you usually see the opposite. So the 3-month will have the lowest yield, and the 30-year, or in this case, the 10-year, will have the highest yield. So that's what a yield curve inversion and uninversion is. Typically, when the Fed's raising rates, stocks usually go up, and when the Fed cuts rates, stocks usually go down, especially after the uninverted yield curve takes place, meaning that the lower yields go back down below the higher yields. So, with that being said, when the yield curve uninverts, typically speaking, there is a large drop off in yields. As you guys can see here on the 2-year, we've gone up pretty substantially in the yields. And also in the 10-year, we've also gone up very substantially as well. So let's get into the charts and what this actually means. So as you guys can see here, we have basically we have what's known as a chart overlay. So we have the 2-year, 10-year chart here. This is the percentage point spread between the 2-year, 10-year. So basically, anything above 1% is considered to be inverted. Anything below 1% is considered to be uninverted. So why did we bring this up now instead of our macro video that we typically do once a month? Well, because it appears that the yield curve is about to uninvert. As you guys can see here, the spread between the two 10-year is only 0.16%. or 16 percentage points. It's very, very tight range. Okay. We think that probably, I would say, within the next 4 weeks, this thing's going to uninvert. Typically, what happens historically is when the yield curve uninverts, stocks, or I should say the entire stock market plummets, usually between 30 to 50%. I'm not trying to scare you guys. I'm just telling you the facts of, or I shouldn't say facts, but the historical data of what typically happens when yield curves uninvert. So let's go ahead and get into it. So as you guys can see here, the most recent example we have is you guys can see it's below 1% here in April 2022. Then it goes above 1%. And as you guys see on the chart on the left, we did hit a peak here. And then you get the uninversion. And of course, it goes back to being inverted. But this is just a small example of what uninversion can do to a market. So you guys can see here that we dropped pretty substantially just on this move alone. You're talking basically like about a 20, I would say like about a 17 to a 20% drop on the SPX or the S&P 500. Now let's go back a little bit further. So you guys can see here that we went from being uninverted to inverted in August of 2019. Actually, I'm going to pull the charts back a little bit so you can see this. So nothing really happened right away. So you guys can see that we were close to getting uninverted here. It didn't happen. We got inverted here, and then we became uninverted. Nothing really happened right away for like, I would say, probably a good about 6 months. And then all of a sudden, we dropped off a cliff. Okay. It went from being inverted to uninverted, and then boom, stock markets just absolutely plummeted. And as a matter of fact, these sell-offs were so aggressive during the Rona dump that there was multiple. What is it called? There was multiple circuit breaker halts that happened in the stock market. Basically, what a circuit breaker halt is a technical term where if the stock market drops more than 5% in a day, there's this thing where the indices are halted for like a 5 or 10 minute period, so investors can kind of sit back and collect their emotions and think about what they're doing before they decide to panic sell further. It's kind of meant to help investors not really overreact, so to speak, which, as you guys can see here, that's basically what happened. I mean, we had a time frame of about, during this pandemic dump, we had a time frame of roughly about, from the top to the bottom, 49 days. So basically about 7 weeks. As you guys can see, there's a pretty strong overreaction here. We did actually buy some funds, some index funds during that time frame. I kind of wish we had bought crypto instead, but is what it is. So we're going to go back further to the most previous recession, which was the Great Financial Crisis of 2008. So as you guys can see here, we kind of take a look at the macro time frame. We could overlay the Fed funds rate too, but we'll do this in a separate video. So 2004, it appears that the Fed started raising rates because the yields were going up. We got to a point where we were basically kind of inverted back here in 2006. You guys can see that nothing really happened. We got uninverted for a slight moment, but then became inverted again. So because of the fact that the uninversion was such a small time frame, just a couple of months, it probably wasn't really going to affect the markets. So basically here in February of 2007, we didn't really see much going on. And then right about here in July of 2007, the yield curve uninverts. And once again, you guys can see that things didn't really play out immediately. So it took roughly about, I would say, 6 months before the market started selling off. We did actually see that in a previous example too. So the yield curve inverts here, and then you just get this kind of really quick sell-off of yields. But it wasn't until we got the bounce here in June of 2008, so roughly about a year later, that things just absolutely plummeted in stocks. And it really just took a nosedive here, historically speaking. And we had a massive drop here. We had about 57% on the stock market. Keep in mind, this is the entire index. This is all of the stocks in the S&P 500. Okay, this is not individual stocks. So we're going to go to the last example here, most recent one. I mean, we could go all the way back in time, guys, but there's a lot of examples that we could use for this, but we would just want to use the most recent ones within the last 25 years. So we're going to take a look at the dot-com bust here. As you guys can see, it looks like the Fed had been raising rates for quite some time, or the yields had been higher for longer. We'll have to go back and do a comparison between the Fed funds rate and the yield curves. But you guys can see that even after yields were going up, the stock market didn't really do much of anything. It kind of just kept going up. And as soon as yield curve uninverted, I mean, that's kind of when the crap show started to happen, so to speak. And then, after that, markets basically fell off a cliff. And we went down about 49%. So I guess the thesis here could be made that the most likely scenario is that stocks are not going to sell off right away after the yield curve uninverts. It might take like maybe I would say 6 to 12 months, or maybe 3 to 6 months, something like that, before stocks start dumping after the yield curve inverts. Now, keep in mind this, when it's sitting at just 3 percentage points above break even, it doesn't necessarily mean it has to uninvert, but the thing that you guys need to understand is that the Fed is much closer to cutting rates than they are to hiking rates. Remember, they began hiking rates back in March of 2022. They said that they were going to start hiking rates in November of 2021. So the markets have been pricing this in now for basically almost 2 full years at this point. And based on history, the Fed is not going to raise rates forever. We're much closer now than we were to either holding and or cutting. The Fed's only raised, I think, like 125 basis point hike in like the last 3 or 4 FOMC meetings. So they're pretty close to getting to the point where they want to cut. So with that being said, another kind of mitigating factor here, or hedge against the thesis of the markets dumping on the uninversion of the yield curve, is that you guys can see here on the CME group S&P 500 futures E-minis. There is a bigger contract than this, but I believe that's only available to institutional traders, not retail traders. So this is as far as I know, the biggest contract that retail traders can trade is the E-mini, and then there's a smaller one called the micros. But this is the CME quotes and settlement prices, as we've showed you guys before. This is basically what they're projecting out into the futures. So as you guys can see on a kind of a snapshot view here, the CME exchange is not really projecting some humongous, colossal stock market crash. And we have told you guys that we think, based on the fact that the Fed was raising rates last year and the markets tanked, which is usually not what happens, we do expect the markets to go sideways and or up from here. And CME kind of mirrors that perspective that we have. Again, typically what would happen in a rate hiking cycle is the Fed would raise rates and the markets would go up. But as soon as the Fed cuts rates, then the markets would drop. But we didn't see that last year. We saw the opposite, where the Fed was raising rates and the markets dropped. Usually the Fed raises rates and the markets go up. So you guys can see here that basically the prices are flat and or up over time for basically 5 years out. If we click on the settlement dates, we'll see something very similar here. So these are the settlements. So December 2023, which is 2 months from now, you're talking 42.48. That's basically pretty much right where we are in the SPX, as you can see on the chart. And then the next roll date or settlement date would be 43.45 in March, 43.92 in June, 44.43 in September, and this is in 2024. And keep in mind, so when we trade futures, we have 3 months in between having to roll the contract forward to the front month. Keep in mind that during those 3 months, anything can happen with the price action. Okay, just because this says 42.95 doesn't mean it couldn't dump down to 3,800 and then rally all the way back to 42.95 by the time the settlement contract takes place, okay, or the settlement date. So you have a massive 3-month gap here in between each of these settlement dates. So that's just something to keep in mind. But anyways, this is the uninverted yield curve versus the SPX and how it could affect dividend investors. We hope you all enjoyed this content. Please like, comment, and subscribe, and we will see y'all later. Peace.